Welcome back to the Kickstart Garage. I'm your host, Sam John Byrne, and I'm accompanied by my co host, Gavin Quigley. On today's show, we're joined by Brain Feroldi. Since 2015, Brian has been covering the healthcare and technology industries for the Motley Fool. More recently, he's been spreading financial wellness content via Twitter and YouTube. If you haven't already caught wind of his content, I definitely recommend you check it out. Anyway, welcome to the show, Brian. How are you doing?
Sam, Gavin, awesome to be here. Thank you for having me.
It's a pleasure to have you on. So I've been following you for a while now over on Twitter and more recently YouTube. And I'm a big fan of the content you put out. Your tweets are little golden nuggets of information, and I'm a big fan of your over the shoulder approach to researching stocks on YouTube. As I understand, you're on a mission to spread financial wellness. Could you talk to us a bit more about that?
Sure. I don't know how it was in your family growing up, but in my family growing up, money was a bit of a taboo subject. We never talked about it at this dinner table. I never heard adults talking about it in good conversation with each other. And I think largely in most families, that's a pretty common thing where money is just something that is not discussed in polite company, which is so strange because money is one of those few things that literally impacts every aspect of our lives. And we're not taught anything about money in school. We're not taught anything about money directly unless our parents talk about it. And yet, once you are out there in the world on your own, you're just magically supposed to have everything all figured out, right? It's like if you've never been through budgeting or understanding a mortgage or interest rates or anything like that, you are just prey for financiers out there, and it's no wonder why so many people just waste so much money paying interest on credit cards and get into troubles with consumer debt and things like that. So thankfully, there's a strong movement of people online who I would consider to be true financial educators that are out there to are really truly trying to help people understand the things that they need to know about money, essentially filling in all the gaps about money that we should have been taught in school. So I discovered about 15 years ago that that's why I was put here on earth, to help other people do better with their money. So that's my mission.
Fair play. And for yourself, like, because I know you're a fantastic content creator, who do you follow?
So I really learned the most about money in the 2000s. So many of the biggest creators from the biggest money experts from that era were really the people that shaped my investing philosophy the most. So I'll throw Dave Ramsey in there, the Motley Fool in there, Susie Orman in there, Robert Kiyosaki in there, David Bach in there, etc. More recently, a kind of new crop of money experts have cropped up. So if you're familiar with the FIRE movement, FIRE, financial independence, retire early, I would say choose FI and afford anything are two of my favorites. Kind of the godfather of FI and making that popular is Mr. Money Mustache. So there are just so many people out there today that are creating wonderful content that's just easy to access, that really nails down the important concepts about money.
Yeah, I think you mentioned Robert Kiyosaki there. I think he's almost a starting point for anyone. Anyone I talk to is always it's Robert Kiyosaki. Anyway, what I think you're doing is fantastic, and it's something a lot of people need. During the initial lockdown of COVID, I had close friends diving into investing because they've seen a lot of people making money from meme stocks and crypto, and some thought they were actually buying shares, and instead they were actually buying CFDs. It's been crazy. But for those interested in getting started, what is the first step they should take?
I actually think the first step to getting started investing is to not invest, and that is really to back up and really look at your personal finances first. I am as big a believer in the stock market and investing as they come, but I also firmly believe that what you do with your personal finances is an order of magnitude more important than what you do with your investing finances. So if you are brand new to the world of investing, the first thing is always start with education. Educate yourself. Start to read books, watch YouTube videos, listen to podcasts. Really make sure that you understand what you are doing before you do it. Beyond that, I would say look at your personal life. Do you have any consumer debt? Do you have any credit card debt? Do you have any student loan debt? Do you have any high interest debt of any kind? Don't invest if you do. Wipe that out first. Step two, make sure that you have a fully built out emergency fund for yourself. Life is going to throw you a financial curveball at some point. There's no escaping it. No escaping it at all. If you have to If to fund that emergency fund, you have to dip into your investments to do so, and you have to sell your stock investments, the odds are pretty good that you're going to be doing it at the worst time possible. Any money that goes into the market, you should be committed to not touching for a period of 5 years or more. So really start with education, knocking out your debt, and getting an emergency fund before you invest.
Some brilliant, brilliant bits of advice there. I know a lot of people listening will be just starting off their journey. So, definitely some fantastic advice there. As many know already who'll be familiar with you, Brian, you use a checklist when it comes to investing, which I think is a very underrated approach when investing. There's a vast array of information out there on any one particular company, and it can be very easy to get caught up in all of it. So using a checklist can help you just like keep that focus, knowing what to look for and not veering too far away from the objective. Could you take us through that checklist?
Sure. So I developed this checklist a few years ago. And prior to having this checklist, I was essentially trying to keep all this information in my head, which is crazy when you think about it. Like, there's so much that goes into analyzing a company, analyzing a business. It's kind of nuts to try and do it all in your head. Finally, I got smart enough to say, maybe I should write this down, and maybe I should come up with a system where the system helps me identify what companies I want to invest in and what companies I don't. So I started by asking myself, what are the attributes that a company has that makes it a very attractive investment for me? Things on there would be a very strong balance sheet, a high a gross margin, strong returns on capital, free cash flow positive, net income, a strong competitive advantage, a huge addressable market opportunity, an invested management team, etc. Made this big list. Then I made another list. And that list was, what are the traits that I hate seeing in companies, that I absolutely do not want in any companies that I invest in? And those are things like accounting irregularities, customer concentration, where a few customers make up a lion's share of a company's revenue, over dependence on commodity prices, high dependence on interest rates, losing money, a stock that has gone down a lot since IPO, high dilution, antitrust concerns, etc. So I made these two lists, all the things I like, all the things I don't like. Then I ranked them according to a weighed system that came up with. Now, the weighing part here is the crucial part. I forced myself to dole out 100 points to all of the attributes that I liked about a business. This was an idea that I got from somebody that was helping me to create this checklist, which, by the way, is a big benefit of sharing this information in public. The feedback that you get from other people is invaluable. But I went through and doled out 100 points to one of seven. 7 categories. So financials, I gave 17 points to. The moat, I gave 20 points to. For the potential, I gave 18 points to, etc. And what I really liked about that limiting yourself to 100 points is that you can't add points to something without subtracting them from somewhere else. So if you don't have a limit on the number of points you can do, it's really easy to say, I should keep adding points to this category, and there's no, you keep going higher and higher. So the forcing yourself to have an upper limit, an absolute limit, really forces you to focus on the attributes that matter most to you. So the categories that I came out with are financials, moat or competitive advantage, potential, which is the long-term trajectory, potential trajectory of a company's financials, the relationship between the company and the customers, specifically, are customers expensive to acquire? Once a customer becomes a customer, are they going to be buying no matter what is going on in the economy, or is their spending patterns dependent on cyclical factors? Does the company have recurring revenue, or is it a one-time sale? Does the company have pricing power, or can the company raise prices and not lose any of its customers? I also take a look at the management team and the culture. And the final thing I look at is the stock itself. I am a big believer in the statement that winners tend to keep on winning and losers tend to keep on losing. So I actually pay attention to how the stock has already performed for investors. And if a stock has already thrashed the market, that's actually a really good sign for me. And if a stock has lost very badly to the market, that's actually a bad sign for me. So those are the categories, and I assign points. So they're building points at that point. Afterwards, I start subtracting points for the things that I don't like. So again, accounting irregularities, customer concentration, industry disruption, commodity prices, extreme dilution, etc. And the output of all of that work is a score that I can compare to other companies. Now, that isn't the final determination of whether I buy this stock or not. The score I consider to be a quality score for a business. How interested would I be in putting this company into my portfolio? So I've done this now hundreds of times. So I have this big database of scores for companies, and it gives me a really good sense of what companies am I interested in owning and what ones that I'm just never gonna touch. When I'm actually looking to deploy capital, I go through my list and I say, what are the highest scoring companies that I have trading at, and which of those companies are trading at the most attractive valuations, and which of those have the longest growth potential ahead of them. So it's kind of multiplying those three things together. The ones that score the best, I buy.
That is insanely comprehensive, and like think about the actual value of that database after you've had a few years and looking at those companies. Have you ever thought about like back testing it?
So I have looked into back testing it. There's a couple of problems with my back testing. The first problem is I've only had it for a few years, and the market's been straight up and to the right during those years. So I don't know how. It's not like I have 50 years of data that I'm looking at. That's problem one. Problem two is again a big positive for me is the stock has already beaten the market, and a big negative for me is stocks that have already lost to the market. So looking backwards with this, it biases up companies that have already beaten the market and biases down companies that have not beaten the market. So it's not pulling from like a true data set. Basically, everything that scored, most of the companies that score great have already thrashed the market because that's what I'm selecting for. So I think that's a limitation of the system. So I have no data to prove this works. Other than my own portfolio, but I'm committed to implementing this system continuously for many years. And as long as I am beating the market over rolling 5 year periods, I'm going to stick with it.
Yeah, I mean, it kind of leads to my next question. Like you've got a system now that you've put a lot of time and effort into. That's, I suppose, a culmination of all the research that you've put in and the study that you've done in investing. Like, is that checklist ever evolving? Would you ever iterate the checklist and then go back and amend all the scores, or is it something that's going to be rigid for the foreseeable future?
It's been pretty rigid for the last two or 3 years, but I am fully open to making changes to this thing as my thinking evolves. There's no point in being rigid about your thinking at all. I mean, this is, I would say, version three of my checklist as it exists today, and I'm quite happy with it. But for example, one change I've been thinking about making. Currently, my system devotes 15 points of 100 to the how strong I think the current moat is, how strong the current competitive advantage is, and it devotes 5 points to what direction the moat is going. So, is the moat getting wider, or is the moat stable, or is the moat narrowing? I actually am seriously consider switching that to be so that there's 10 points for the size of the current moat and 10 points for the direction of the moat. Because one thing that I've learned in the last few years is that the most value is created not necessarily when not by a company having a moat, but when a company goes from not having a moat to creating a moat. Like, what was Amazon's moat in 1997? It was not much, just counter positioning, in my opinion. It had a differentiated business model. What's Amazon's moat today? Well, there's a lot. There's a lot going on. I would say they're a low cost operator. They have a brand value. There's switching costs for consumers, all of those things. So the value that created from Amazon was them building a moat, not necessarily them having a moat.
And so, like hypothetically, you've already alluded to this a couple of minutes ago, Brian. But let's say you're investigating two companies, and these two companies, they seem pretty much neck and neck on all fronts. They've scored literally identical scores. Is there, you only have, let's say funds capital that you're going to allocate to one, and you want to make a decision? Like, how do you handle that situation? Is there another metric that you immediately go to kind of help you juxtapose the two and distinguish which one is going to be better?
So again, so if they had the exact same quality score for me, my natural inclination would be to buy whichever one has a smaller market cap, and because that would be at least one indication that the upside potential would be larger. So if let's just say hypothetically, let's say two companies score 80, which is a really good score. One's a $50 billion market cap, the other's a $10 billion market cap. I'm probably going to put capital towards a $10 billion one because that tells me this is a really high quality company that has, it could go up 5x. It would be the same size as the other company. So again, it's the quality score is an important component of it, but from there, it's valuation is a component and potential is a component.
Brilliant, brilliant. And you've touched on a couple of things, I suppose. Like obviously, there's so many factors that could come into play outside of the quality score. I mean, you touched on like previous performance being really good, actually indicating that look, it's probably actually going to continue to perform well. Are you ever concerned that there might be like really lucrative opportunities that like might not be captured by your checklist? And how do you go about like managing that FOMO, the fear of missing out?
Yeah, that is a limitation of my checklist. I mean, if I was to define my investing style, what I'm really after is high upside potential, low risk. I'm after the highest growth, highest potential stocks that I can find that are simultaneously low risk companies. You would think that that dichotomy wouldn't exist. Like there'd be no such thing as a low risk company that also has high return potential. But I actually disagree. I actually think there are companies out there that are compounding machines, extremely strong, founder led, profitable, high growth, huge opportunity ahead, and simultaneously still have large upside potential. So that is really what my checklist is centered around finding. I am looking for those opportunities. So if I come across a company and it scores poorly on my checklist, that doesn't mean I think the stock's going down or the stock doesn't have upside potential or none of that. That just means that the risk is higher. And the risk for me, it would just be a very high potential, but also high risk stock. And that would just be something that I say, almost always pass. Why would I put my capital behind something that is high return potential, but is also high risk when I think there's companies out there that have high return potential, but are also low risk?
So let's just talk a bit about valuation. Mentioned earlier about Robert Kiyosaki. So my story was I picked up Rich Dad Poor Dad, and from Rich Dad Poor Dad, I went to the Intelligent Investor, and that's when I started out. It was like placed a huge emphasis on valuation. You know, being able to buy a dollar for 50 cents, the whole Buffett philosophy. But over time, I've learned that it's not the be all and end all when it comes to investing. You can actually miss a lot of opportunities if you place a heavy weight on valuation. That's not to say to completely ignore it, but I'm curious to know what kind of weighting you place on valuation in your investing process, if at all.
It sounds like we've been on similar journeys ourselves because my natural inclination as a consumer, let's just start with that, as a consumer, is to look for bargains. Like I have been trained my entire life to pay as little as possible for whatever it is I'm buying. So like you, when I first started investing and I first studied Buffett and Graham and all of them, I was also looking for the low valuation companies. That was the lens through which I observed the market. Right. So when I became a member of the Motley Fool, one of the best investor at the Motley Fool, in my opinion, is David Gardner, who's the co-founder of it. And he would go and he would recommend these stocks that traded at huge valuations, like price to earnings ratio of 200, price to sales of 15. And every time he made a recommendation, I'd be like, are you kidding me? Like, how can you buy this stock? The valuation is insane. It's insane. You can't buy Amazon. It's trading at 100 times earnings. You just can't do it. And yet, after observing his style for years and years and years and learning more about how valuation works, like you, I have learned the hard way that you have to de emphasize valuation. So I always look at valuation, but when the upside potential is there, you really can't make valuation the first thing that you look at. You need to make it like the 10th or 15th thing that you look at. But that also gets into the quality of the company and the upside potential. So I'll just make a general statement. If I come across a company that I think is extremely attractive, extremely exciting, and the market cap is $1 billion, okay? And then I ask myself, if this works out, if the company executes against its plan, and I could see this being a $20 billion business someday, right? So that would be a 20x return from the current market value. I'm not going to look at valuation. I'm just going to buy it. Period. I'm just going to say the upside potential here is so huge that if I'm right about the company, I can make 20 times my money. So I'll pay 50 times sales, 1,000 times earnings, whatever it is for that $1 billion company. Conversely, when a company is fully mature, fully optimized for profit, and fully past its hyper growth mode, like say FANG is today, Facebook, Alphabet, Netflix, Google, etc., those companies have really achieved the hyper growth of those companies is in the past. They have plenty of growth ahead, but the hyper growth is in the past. With those companies that are already optimized so heavily for profits, I'm going to put valuation like third or second, because for them the what is the real return potential for you as an investor? I mean, Apple is a 2 trillion dollar company. For it to double, it has to become a 4.4 trillion dollar company. So for a company like Apple, like Microsoft, like Facebook, or any big slow moving company, I would really emphasize of valuation. So it's not that I ignore valuation in all cases. It always depends on where the company is in its growth cycle and what I think the upside potential is.
That's a really good reasoning, and it's kind of ties hip and hip with Buffett. Just buy a great company and the share price will follow. But on that, for those listening to your show, you've mentioned this acronym, growth at a reasonable price. Could you elaborate on how you find growth at a reasonable price?
Yeah, that's a term that I love. GARP, growth at a reasonable price. And the reasonable price means different things to different people, and it also depends on a company's a company's growth rate. Um, broadly speaking, the idea behind that is that you're willing to pay a premium for a growth stock, but you're not willing to pay any premium for a growth stock. So if you think a company is growing at say 20% profits at 20% per year for the next 5 years, maybe you're willing to pay 30, 40, or 50 times earnings, but you're not willing to pay 80, 100, 200 times earnings. So that would be a lot about how I invest. So valuation again is a part of my investing process, and I always look at the valuation before I buy anything. But again, it's about factoring in what do you think is a reasonable growth rate for the company, and what do you think is a reasonable price to pay. And again, the higher the growth potential, the more of an unreasonable premium I'm willing to pay, and the lower the growth potential, the more valuation focused I am.
So moving away now from kind of active picking, and we'll talk a bit like more so in the context of the average Joe. In Ireland, the tax around indexing is actually pretty penalising. As it stands, you have to pay 41% tax on unrealised gains every 8 years, or on disposal of ETFs in particular. And both parties, investor and government, in my opinion, are really losing out because of the gains that can be made through deferred tax compounding. Yet at the same time, with interest rates being so low, it's still a pretty good bet for beating bank deposits. Do you believe there's a better alternative to indexing when considering sound investments for the average Joe?
Let me just make sure I understand what you just said. You make an investment, it doubles. You buy an index fund. over the next 8 years, it doubles and you don't sell, you have to pay 41% tax on the gain.
Yep.
That is crazy.
I'm sure I see on Twitter usually, like, I heard there's a bit of chit chatter going around in the States as well with unrealized gains or capital gains tax coming in. Is that true or not? Because I've seen loads of people complaining about it.
I mean, yeah, it's been proposed, but I doubt that'll ever go through. And if it is going to go through, it's going to go through on just mega billionaires, especially in the beginning. But so let me ask you this: what happens if you sell it? What happens if the loss disappear? What happens if the gain disappears, or what happens if the gain turns into?
No offsettable losses. Yeah, it's crazy.
I'm sorry. God, that sounds terrible.
Yeah, it's awful.
In today's environment, I don't know what the interest rates are locally for you guys. For here, they're nothing. I assume they're nothing or low or maybe even negative. But yeah, today investing today is really hard. I don't know what asset prices are broadly for like real estate and stuff in Ireland. In the United States, all asset prices are high, all of them. Anybody that's seeking to find any yield on their money at all, really, they've been forced into the stock market. And the stock market isn't trading at like bargain prices today, but on a relative basis, it's really the best thing that you can it's really the best thing that you can do. Like if you need a yield or you want a return, bonds aren't going to do it for you. Cash isn't going to do it for you. Savings isn't going to do it for you. So that leaves you to go into things like cryptocurrencies or the stock market or real estate. So yeah, I don't have a good answer there other than to say I still think over the long term, index funds are a great choice. However, that doesn't assume a 41% unrealized tax on your losses. That's awful.
Yeah, like I was talking with Emmett Savage about it, and the kind of what we were thinking is just, similar a quant strategy, even with a low turnover, similar to say the acquirer's multiple or magic formula investing. I think that's the only hope that we have. But and two great strategies too. But let's talk a bit more about portfolio management. As of recently, I've started to place a greater emphasis on the management of my portfolio. So, from the level of turnover, given the tax rates here in Ireland, as I mentioned, to the mix of market capitalization and exposure by industry, I was wondering if you could talk to us a bit about your portfolio and position sizing principles.
Sure. So for position sizing in general, I own about 80 individual stocks, roughly 80 stocks, which sounds like madness to some people. They're like, how can you own that many? That's just way too many. You're just way too diversified. But that's a strategy that works for me. And my if you actually dig into the look at the portfolio, it's far more concentrated than it would appear if you just heard that I own 80 stocks. So broadly speaking, my portfolio is kind of like a cruise ship. Like I move it really, really slowly. So if I want to make a change to it, like I have to like start turning like a while ago for things to happen. But I'm okay with that because I basically consider myself my portfolio to be an index fund where I pick everything. Like so, I just want once it gets in there, I'm gonna hold on to it for a really long time and let that company do all the work for me. Which means that I'm gonna own some losers, but it also means that I'm going to get a couple of winners in there, and those winners are going to win so much that the entire portfolio is going to benefit. So when I'm deploying new capital, if I came across an idea that I a brand new stock that I was interested in, I would buy some of that stock like immediately, and I would devote about half of 1% of my portfolio's capital to that stock like immediately just to get some skin in the game. From there, I watch the company and I after like a quarter or two, I say, is the thesis for this company playing out? Are the reasons that I bought the company coming to fruition? If the answer is yes, I will consider adding to it. And one way that I add to it is by looking at these things called value points. This is a concept that this brilliant investor named Tom Angle came up with that I just absolutely love. So let's say I find again $1 billion company that I think has huge growth potential. I'm going to buy some immediately, and at the time of purchase, I'm going to write down what is the price to sales ratio? What is the price to gross profit ratio? What is the price to free cash flow ratio? What's the price to earnings ratio? What's the forward price to earnings ratio, et cetera? Let's just say I'm paying 10 times sales and 100 times earnings for that stock. Then move forward, and that company is executing. Sales are up big, profits are up big, et cetera. Um, with my next purchase, what I'm trying to do is buy that same stock at a lower valuation. So I'm trying to pay 9 times sales, or I'm trying to pay 90 times earnings or less, regardless of where the share price is. So that could mean I'm paying a higher share price, but if the share price is up, say, 10% and earnings are up 30%, that means I'm buying it at a better valuation. I'm buying it at a better value point. So with each future purchase, I'm trying to get it at a better and better and better value point moving forward, which kind of lowers my risk profile moving forward. Again, assuming the company is executing. Now, that's not always possible. Sometimes companies are executing so unbelievably well that you have to be willing to buy at a higher valuation. For example, the first time I bought Shopify, I don't know the numbers, but I was paying a high valuation, and then Shopify's numbers kept coming in, and you're like, oh my god, this company's doubling like every earnings report what it's doing. So I just wanted more capital in that, so I did pay a higher price. But broadly speaking, my strategy is to move in small chunks and to buy at better and better valuations, not prices, valuations over time.
It's logic and it's sound reasoning. Um, I've fallen victim a number of times to keeping too much cash on the sidelines because I thought, market's overvalued and you always want cash there in order to take advantage of the downturn. How do you handle your cash balance?
Yeah, I thought the market was overvalued in 2015, if that gives you a sense of my market timing skills. So I always want the vast majority of my capital invested in the stock market, because if you just look at the numbers, the stock market goes up 2 out of every 3 years, and the numbers clearly show you want your money in the markets. You don't want it on the sidelines. But like you, I also want some cash on the sidelines to take advantage of any opportunities that I see. Broadly speaking, with my portfolio, so this would not include cash that I have in my savings account or checking account. That's part of my emergency fund. That's separate cash. I keep somewhere between 0.5% and 10% of my portfolio in cash at any given time. Now that cash balance can go up because I'm just putting more money in and I'm not buying anything because there's nothing that's like a screaming buy to me right now. So that would raise the cash balance. Or occasionally I sell stocks if I was just wrong about them, or they get bought out, for example, and those companies become cash. But broadly speaking, my cash balance is usually somewhere between 1% and 5%. That's where it lives most of the time. But I know investors that are always 100% invested, always. And I know investors that always keep 30% cash on the sidelines. I don't think there's any right or wrong way to do it. I think there's validity to both strategies. I just know for me, I just want almost all of my money in the stock market all the time.
Yeah, I think some people like they can only sleep at night when they have cash in their like normal bank account, and some people they can only sleep when all of their cash is in the stock market. So I think it's just whatever helps you sleep at night, you know. And an element that I've struggled with is the assessment of the company's management team. I've actually picked up a few bits from watching you doing deep dives over on YouTube, such as checking out the glass door reviews, which I think is really, really smart. Could you talk to us a little bit about how you go about the assessment of a company's management team?
Yeah, management is a huge factor in finding a good investment, because they're the ones that are making all the capital allocation decisions. They're the ones that are hiring. They're the ones that are in control of the policies. They're the ones that shape the corporate culture, launch new products, etc. Their decisions making make or break the company. They are 100% responsible for execution. And it's execution which drives financial results, and financial results drives the stock price. So they're critically important. As individual investors, it's not like you can call up the CEO of a company and say, "Hi, I want to interview you. I have some questions for you." That's not something that we can do. So how do you judge them? Thankfully, today it's never been easier to be able to judge management teams, although it's not necessarily easy, right? So on my checklist, I devote 14 points to management. I think it's important, and there's a few shortcuts that I think that investors can use, so that you never have to meet or talk to the CEO, but you can judge whether or not they're doing a good job. The first thing I look at is their tenure. How long have they been at that company for? The best answer there is I founded it. Right, I founded the company. Founders are like a cheat code to investing, because if you found a company and it goes all the way to being a public on the public markets, there's no way you're not ridiculously wealthy. Like there's no way you are not already ridiculously wealthy. You have at least $5 million, more like 50, 100, or maybe even $1 billion. Like you are set up financially for the rest of your life. If you were set up financially for the rest of the life, why would you be a public CEO? There has to be some other reason why you are interested in doing that. And a lot of founders found companies in the first place because they see an opportunity or they see a problem and they are passionate about fixing it. So I love to bet on founders. Second reason I love to bet on founders is because the board and the investors generally give that founder a lot of leeway to operate the company how the founder sees fit. And occasionally, companies have to make big, bold bets on new ventures. And if the CEO is a hired gun, a lot of times they have to do a lot of convincing to get the rest of the board and stuff on board. But if they're the founder, a lot of times the market gives them the ability to do so. Famous recent example was Reed Hastings, excuse me, at Netflix in 2011 when he basically said, "We're going all in on streaming. We're essentially killing our DVD by mail business, and we are going 100% in on streaming." That's a bold bet. That's a really hard thing to do. But the market gave him the ability to make that pivot. The stock fell 85% in the short term, but he still had the gumption to do so. So I allocate points based on. So best case scenario, they founded the company. Second best case scenario is they've spent their entire career there. And third best case scenario is they've been there at least 5 years. I don't like it when new CEOs are brought in because that's like a wild card. And new CEOs don't always mesh with the corporate culture and they can screw things up. So that's one thing, just tenure. The second thing I look at is skin in the game. How much of the stock do they personally own? Essentially, I want, if that stock goes down, I, the shareholder, get hurt. I want them to be hurt way more. I want their finances to feel it way more than mine. So I want to see millions, at least millions of dollars in stock on the line. Third, as you pointed out, I like to check Glassdoor. Glassdoor is, again, kind of like a cheat code for investors these days. I mean, who knows a CEO better than the people that work for them? Who feels the pain of that CEO's decisions more than the people that work for them, right? And they will go on Glassdoor and they will be completely honest about what they like or don't like about CEOs. So, side note, if you just go on Glassdoor's highest rated CEOs list, and look for public companies, that's a pretty good shopping list right there. Finally, I judge a company by their communication skills. And one of the most important communication skills that they have beyond shareholder letters and how they talk in transcripts and how they do in interviews is the mission statement of the company. I'm a big believer in mission statements, which are kind of like a mission statement is like a North Star for a company. Like if you have a really good mission statement, it aligns all of the stakeholders of a business. So that would be employees, management, shareholders, suppliers, society around that one target. And if that target is inspirational, that just shows that the management team is really good at communication skills. So I think between tenure, ownership, employee ratings, and communication skills, that will give you a really good sense of whether the management team is doing a good job or not.
I'm sure Phil Fisher would be proud of that approach. It's not scuttlebutt, but it's good. The other day, I was chatting to a friend about what drives returns in the market, which led us onto a debate about whether markets are efficient or not. And he was of the belief, for the most part, markets are efficient. And I was wondering if you could share your thoughts on what drives market returns, and do you believe, for the most part, markets are efficient?
Yes, I believe that markets are largely efficient, mostly efficient. However, I reject the idea that markets are perfectly efficient. Markets can't be perfectly efficient. The future is always unknowable. There will always be some news, something that comes out that can't be predicted, and that allows you, the individual investor, to generate alpha. Moreover, who is the market? What is the thing that controls stock prices? Big investors. Wall Street, right? Hedge funds, mutual funds, pension funds, those that are managing billions and billions of dollars, they have the capital to actually move prices. And you have to ask yourself, well, what time frame is that amount of money investing for? More often than not, the answer is months, quarters, or maybe a year. Like that is the time horizon that they are investing in. They have to continually prove to their investors, the people that they're managing, that they're doing a good job and their capital is allocated properly. So they are actually in the asset gathering business. They're not necessarily in the money management business. You, as the individual investors, can reject all that, take an actual multi-year a time horizon, and I believe generate alpha by just looking longer term out than the market does. And beyond that, occasionally the market does crazy things. Like, should we talk about GameStop? Like GameStop's 52-week low and 52-week high were what, 10,000% different? Does that sound like an efficient market to you?
Not at all. Not at all. But anyway, I think that's a good note to wrap up. I know we're coming up on time. So, Brian, it's been an absolute pleasure to have you on the show today. But before we let you go, we'll hand the floor over to you. Can you tell the audience where to go to find out more about you and your content?
The best way to connect with me is on Twitter. I am at Brian Feroldi. And if you're interested in kind of applying my checklist and going through companies one at a time, check out my YouTube channel, which is Brian Feroldi YT, the YT for YouTube, on YouTube.
Fantastic. Thanks again, Brian. And for everyone listening, we'll catch you in the next one.